Do I sound like I could be Idris Elba? Do I sound like...
You're my Idris.
Hey, listen, hey, did you hear that? I am Lorraine's Idris. Hey, that is, listen, the podcast can end right here. Because after that, we're not going to get any better. Pete, we are ready to go. But we are back for another episode of the Property by Kazy podcast. The number one, in my opinion, place to learn about property. So if you haven't already, make sure you subscribe, because what we do each and every week is get an amazing guest. And each and every week is repeated and they get better and better, and they have accumulated with the amazing Lorraine Thomas. How are you doing?
Oh, I'm fine, thank you very much.
Good, it's all right, break the equipment, but we're flowing today. With
we
us,
are really flowing.
Did you see what we do? That was meant to happen.
It's real. It's real.
That was an example that in property, we roll with the punches. Things happen and we just
pick
ourselves up and try.
Again.
That's exactly it.
Yeah.
But Lorraine, for those that don't know you,
Yes.
can you just tell them a little bit about yourself?
So a little bit about me. Well, I'm a property developer. I'm a mentor and a landlord with a social purpose. I think I'm more purpose than I am property, and I say that because I rent to disadvantaged young adults mainly.
Nice.
Yeah.
And your property journey,
Yeah.
you pivoted in your career in terms of your property journey had a really interesting way it started.
Yeah, it did. So I used to work in the city.
Mm-hmm.
I used to head business development and marketing for a law firm. And my dad became ill. I gave up my job to care for him. And one Friday I just went, that's it. Cleared my desk and said, I'm going to care for Dad. Mm-hmm. I didn't know how I was going to pay my mortgage. But a little voice in my head kept saying, don't worry about it, it'll be okay. So I gave up my job. And about 6 months into it, I got an email. The email wasn't meant for me. It was meant for another Lorraine, but I responded to it. Call it serendipity. The rest is history. I started to look for accommodation for my friend's business, which was, she housed young adults that were looked after by the borough. And she needed somebody to go around and find this accommodation. Quite a hard sell into landlords and estate agents saying, look, can you house a young person who's maybe a little bit, disturbed? And but I found out that I was quite good at it, but the accommodation wasn't good. So Dolores and I went off to auction. We bought our first property, and the rest is history.
So you bought your first property, that became a property that you used to house potentially disadvantaged young adults within the borough, and you primarily operate in Croydon.
Yes, so Croydon is my patch.
It's your hub. Am I allowed in? Because I come in Croydon a little bit.
I know. There's but you're allowed. There's enough for all of us. There's enough for all the.
And I think that's really important that there is enough. Just because, and I think sometimes we have a mentality of if I give a gem away, if I speak too much, if I talk too loudly, if I'm scared to talk about money or the opportunity to make money, that it's going to somehow impact the money that you or I make. Yeah. But the more money you make, the more you realize there's enough money out there for everybody to make.
There is so much. And the thing about it is, the more you give is the more you get. Definitely. So actually, there is no point in keeping the gems to yourself, because what's the point in that?
Because a conversation we may have, that, just a conversation about property or about how things are working for you or vice versa, may give some information that you didn't even know you needed to further your own personal development or an actual property development.
Exactly that. And people hang on to little bits that you and I may not think is important, but for somebody else they go, oh, light bulb moment, and I didn't know that. So I always like to share, and that's why the mentoring part of what I do is really, really important, because a number of my mentees, they aspire big, and they come from backgrounds where they've been housed in social housing, or they've grown up in council housing, and they never thought that they could own. But actually the reality is everyone can, and it just takes somebody to say you can do this and this is the way you do it. And so I love that bit of it, and I love the program that I've got going at the moment, which is the Learn, Earn and Own. So a group of mentees that come together. We've got a shareholders agreement. Can't give too much away, but basically it's a way of pooling your money together and being able to purchase and get onto the ladder.
It's nice. I already know from our conversations you're working on a lot of interesting stuff, and it's good to hear just for further of people who haven't watched the old things we've done. So if you don't know, Lorraine was part of the Ask Somebody Else series, so you're able to catch up with that. I'll make sure the link will be in the description below. In addition to that, she was also part of our amazing Property Insiders series. So that was a series that I co-produced with Property in 12. And effectively we looked at the journey of 5 developers and 5 property investors, and there's people that are doing rent to rent, and there's people that are building 200 plus apartments. But they're just really interesting to look at how different people have got their foot in the door, and have more than got their foot in the door and kicked off the door in some instances, and really started and propelled their property journey. So if you haven't, I definitely recommend catching up with that. And because I know you're all going to go and watch those videos, we're not going to talk too much about... In fact, actually, I want to know, to start with, when we last spoke and we did that, we were visiting you on your Thornton Heath site. How's that progressing?
So that sold out. We sold out the whole lot, and then two fell through. But they fell through for a reason, because we went to hold those 2. So we're holding 2 of them, one of the flats and one house, and we're renting them.
So how many units was it in total?
It was 9.
So 9 units, and what was the configuration? How many houses?
It was 2 houses, 1 3-bedroom I call it penthouse.
So you've got a penthouse is definitely what they're called.
And then the rest were 1-bedrooms. So they were really great for people with Help to Buy to get onto the ladder, and that's what we're about, getting people onto the ladder. So you build for the sake of it, but just on that point of building something for the sake of it, we might come on to this a bit later. Do you build out, or do you get planning gain once you've found some land and then sell it on? Because it's a big thing at the moment. It's
a big conversation. I think it's really multi-tiered in terms of that conversation about whether or not to build out. And it's the difference between what you would call a property developer versus a property trader. So a developer buys the asset, invests in the asset, adds value, and then they benefit from the difference between their total investment versus the GDV, like the gross development value. Whereas your property trader generally benefits from what we would consider planning gain, or the fact that they're buying a distressed asset under market value. So the property trader would buy an asset and would potentially go out and get the planning. If you want to know more about property planning gain, we actually had Jerome, that's his business, it's called Property Planning Gain. He was talking in detail about how he structures those and how they work. And he actually gave me loads of further insight into how planning gain works. The conversation is really interesting. And I think as a starting point, I would say sometimes it depends on the level of capital that you have. It depends on your experience. It depends on how long you want to be in a deal. What you want to get out of property. And for me, I think the most important part, and again, I think it's different for everybody, is your attitude towards risk.
And what I would add to that is I agree with all of those.
We're agreeing. We was arguing last time. Lorraine, wait, are you going to leave me? We're agreeing today.
We're agreeing today, which is really good. What I would add to it is to just say that sometimes these things take longer than you think. That's the first thing. So if you're not in it for the long haul, then don't bother starting, because things happen in property. We saw at the beginning of this, podcast, where things just happen, and you have to prepare for the worst. And I think with funding as well, those that are funding you, if they're funding you for a year or they're funding you for 24 months and you go over that time, there are some serious penalties, or you might have to come out of that deal, pay them off, and then you've got to go into another deal which might cost you a bit more, but it will give you a longer time to build out and sell on. So there's a whole raft of things when people go, I just want to build up, I just want to build it up. So there is a whole raft of things.
That's definitely a consideration in regards to when you're agreeing funding.
Yeah.
I think you have to give yourself wiggle room. So if you, for example, you've got, let's like make a fantasy project. So we say the project costs 500k purchase price.
Right.
And you've got to deal with your investor, whatever it might be, a fixed percentage maybe, and you've agreed a certain amount of funding at 6%, 8%, whatever the percentage that you've then agreed.
Yeah.
You've agreed it for,
whatever. Yeah.
You might have agreed it for 12 months.
Okay.
But for argument's sake, if you need planning right now, although they may have deliverables of 12 to 16 weeks, the reality is that could take 6 to 8 months in some boroughs. Particularly because everybody's citing COVID as an excuse. Then we've seen the impact of the unfortunate, current social climate with the current war between Russia and Ukraine.
Yeah.
Brexit affecting material prices and material availability means that you have to plan for a lot of what ifs. And if you've got a contract that's almost ironclad in the lender's favour, i.e. you pay me back in 12 months or else we dispose of the asset, you put yourself in a position where you're really exposed.
Yeah.
Now, potentially sometimes it's better to maybe offer a more favourable return, but to have a contract that's more hedged in your favour as the lender. So, as the borrower. So potentially maybe you have, like, for example, when I've borrowed in the past.
Yeah.
And I've had the experience with bridges where maybe, they wanted to come to the end and maybe a sales fell through, which meant that you can't repay the bridge.
Yeah.
To mitigate risks, potentially you could say, okay, I'm borrowing this money for 12 months at 6% for argument's sake.
Right.
However, if it goes beyond the 12 months, I will offer you, and a portion.
And if you can get 6%, tell me where that 6%. But anyway.
Yeah. But say, for example, you get that 6% and then you said, okay, look, if it goes beyond the 12 months,
right,
for anything from 12 to 24 months, that you get 8%. Because they then are getting a benefit from giving you more leeway, but it also gives you the benefit that hopefully you can take that time to still make money. And I think
you don't have to change lenders and borrowers, which is very expensive. So you're right.
And I think that's where it comes from, actually planning, pray for the best, prepare for the worst. So planning for a longer term, and understanding what it is your likely deliverables are going to be throughout the project.
I think that's right. But there are you mentioned some of the factors, the external environmental factors, which doesn't make building out as easy as it was before. And I just think that, and I'm going to throw it out there, it might sometimes be better to actually get the planning permission and then sell it on. Only if you are in a really strong position with your builders, the costs, your builders well, all of those things tie together and you can pin them down to get your job done in a certain time scale. Is it worth the risk?
Yeah,
I'm just going to throw that one out there.
I think my response to that would be, and again, if we use the example, it depends on circumstance, and a lot of the time depends on your return on capital. Because if you've bought a property for, let's say, £500,000 with a bridging loan, which is a short-term funding product specifically for flipping properties and developing properties. So you've maybe bought it with a 70% loan to value, so 30% deposit. So in that property, you've got approximately £150,000.
Yeah.
That's your money in the property. Now, because you get planning, it's now worth 650.
Yeah.
You could effectively say you got planning within a 12-month period. You could take your money and basically exit, minus obviously your costs of selling and your capital appreciation. Your gross profit in that instance, and minus maybe the cost of your actual planning permission, which say we said was £20,000, you could make £130,000 from your £150,000 you've put into the property. So you're making, you know, really good, like close to 80% returns on investment. And when you now go to build, it all depends on what your GDV is and how likely you are to achieve similar rates of return. But at the same time, there's, you know, a concept of, you know, the alternative best foregone, which means when you make any financial decision or investment decision, what are you losing out on by doing that? So by build, and I say that because if, for example, you're great at finding deals and great at getting planning permission off the land, and you're confident that you can take your money out and repeat it, you're almost 9 times out of 10 better to take that money out and repeat it because it's going to be more efficient. However, we do know, as much as there are deals around, there's not an unlimited source of deals that we're able to go out there and buy. So if you're thinking I might not find another deal for another year, it may be better taking a worse return on investment effectively and actually paying to build out, you know, the property itself.
I think that, that's right. There's so many unknowns, and it's just become like, before you could say you could break it down into 4 chapters. Now you have to look at almost 10 chapters. Because of that end value, like you say, that GDV value, you don't know what that's going to be. For us, luckily, the GDV was more, far surpassed, so it was able to cover the extra building costs that we had. But what if it didn't? You know, you get to the end of the project and you're like, uh-oh, we've done 2 years, 3 years, and we've made
very little
return. So you might as well have just taken the planning gain, run with the money and gone.
And I think, and that's where it comes down to looking at the numbers. And I think understanding your numbers are really important. You know, there's different things to consider as well in terms of, like, you know, it's not just your money, because what if you can get development finance that's going to fund the entire build? That then, even if it's on a drawdown facility, which means you have to have maybe £50,000, even on a 400k build, you can effectively only need £50,000 of your own money and get it repaid in increments. The GDV side is interesting because at the moment we're in a market that's been really, really strong. And it means that it's been a lot safer. Where that market's going to go with all of the pressure factors over the next 2 years is a bit more questionable. And I think that's where I said it's down to your attitude towards risk. Because let's say somebody offers you buy that site for 500,000, and you get planned and somebody offers you 650. Now you can walk with your 650 and make 130. But what if you're, for argument's sake, your build cost is 250k and it's going to be worth $1 million? You're effectively walking away from a further 200k in today's values. Now, are they going to sustain for the long period? We don't know, but it's risk and reward. For taking that risk, you get the potential further reward.
And I think that's right. It's appetite to risk, and it's whether you can withstand the long haul, because it may not be as quick as you think.
What do you think? Like, what's your attitude towards it at the moment? Where do you think you're leaning towards?
I would say always try and buy something without planning permission, and then you've got 2 options, haven't you? Because if you then get the planning, you take the risk, you get the planning permission, then you've got 2 options. You can either walk with that, or you can build it out, depending on build cost and all the other things that we've spoken about. I'm risk averse, so I would say I would always go with let's build it out, but past experience tells me it may not be right for some people, because you've got to have
I think that's what it comes down to in property. A lot of the time when people are having conversations about what shall I do, and I've got this amount of money and I want to get into property, at a starting point you really need to understand yourself. Like, What do you want? Do you want like income? Do you want capital appreciation? Do you want to own the asset for the long term?
Yeah.
Do you want the quick money to do something that you've got other plans, like you've got other financial commitments that you want to use the money to invest in?
Yeah. Would you buy something with planning permission already on it?
If the numbers stack, like
if the numbers were just just getting by, but you knew the area, you felt you could do better with the GDV?
I think that's what it comes down to. It's a lot of the time it is that same principle, and I think it's really weird depending on what like either educational or work background we come from. We tend to use those as the cornerstones of our decision making. So me coming from economics, like these principles of like alternative, next best before gone, it's like, okay, what else could I do? And if somebody was to present, say you said, oh, Kaz, I've got planning on this site. I've got planning on this site above commercial, and we've currently got like 2 2-bedroom flats, and you keep the commercial downstairs, and it's in Thornton Heath, and I think the GDV is 800k, bill cost is X amount, and I'm happy to sell it to you for 450 for argument's sake. And I looked at it and I said, oh, there's 100k in the deal. And I said, okay, you know what? For the amount of money I have to put in, I'm gonna be putting in, you know, all in all, and I did the numbers and I said, I'm gonna have to put in 300,000 for argument's sake.
Right.
That means I've got a 33% return.
Are we all right for time?
Yeah, no, we're good. Just checking in. It's the accountant calling me, but we can, ignore him because we're running Lorraine's numbers right now.
Running my numbers,
And I might look at that and I might say, okay, you know what?
Yeah.
If I've got a deal that's got way better numbers and it's not subject to planning, it's not got planning, but it's way better numbers, then I'm probably not. But if I had a deal, for example, that I had to go through planning and it was a 40% as opposed to 33, I'd probably say, do you know what? For the fact that you've already got planning in place, that 7% isn't worth me taking the risk, because your one is also about, when we talk about your return, something with planning, you can get going day one. And I think that's a point a lot of people miss sometimes. That return, because we're not, unfortunately, in a position where we have unlimited capital, we have to really look at our return on capital employed. And moreover, we even have to look at it annualized. How much money am I making per year? So if I can get in and get out in 1 year, although I may make more money with something that had no planning and you're buying it unconditionally, you may make more money over a 2-year period. And when you annualize that over 1 year, you may end.
Oh, you're going deep. You're going deep.
But I'm a numbers man. That's why I'm a numbers man. So, I completely understand. Like, it's a really interesting conversation, because I think something that's even, now that you've mentioned it, the problem is that I mentioned a deal that's still pretty good, even with planning. The problem is that most deals that people are presenting as deals, they don't leave enough meat on the bone.
Precisely, and that is where I was going with this.
And that's where I was saying it is numbers. And I think particularly the economic climate when we're in, when people are uncertain, they don't, there's more movement in stocks than, than more recently. There's more movement in oil prices, in gold, in more sort of conventional asset classes when it comes to investing. People are kind of like, okay, let me just go back to bricks and mortar. And because London is such a bubble and is so safe to a degree, all investments have risks, let me caveat that, but like, it's so safe, people will take those low returns because if, a product like a mixed stock portfolio is generating 5%, even a 10% return is good. Whereas somebody who's in property and looking at all the work, and we know the work we have to do, like, look, that's not good enough, because you mentioned all the what ifs that could happen.
Exactly. And the other thing is, you may have planning permission, but you don't know what's under the ground, right? So unless you get that soil report, because you could go, right, planning permission, you go to start and you have already kicked off with 100,000 debt on doing a soil survey, and
that meant your foundations that you were planning to go down, 2 meters, you got to do like block and beam for X, Y, or Z, or you have to go down an extra 4 meters.
That could wipe out any consideration for anything that you're saying. Oh, well, the numbers do stack up, but the numbers only stack up if you know all of the other things that.
And I think that's the other side of it. In terms of saying, would I buy something with planning in place? as a rationale for me, knowing that most people that have gone out there and got the planning are developers themselves, why are you not building this out?
Exactly that. And you've got to ask yourself, well, if the numbers stack up and you're selling it for that, why aren't you doing it?
So I think some key points that I would say for anybody that is buying deals or is looking at investing in property and doesn't want to, is potentially quite risk adverse, doesn't want to take the risk of not getting planning, just understand there still are risks involved when buying sites with planning, and you want to see as much as possible. So if agents present you with the GDV, you've got to get second, third and fourth opinions on what those GDVs really are. Don't just say, oh, it's a one bed in, for example, it's a one bed in Brixton, because a one bed in Brixton could be worth 400 and could be worth 600,000 depending on the side of Brixton it is, the building that it's in, what it's adjacent to.
Exactly. And also, all of those things.
The second thing I would say is, yes, there's planning permission in place, but has a structural engineer confirmed that those plans are viable to build? So i.e., potentially, are you looking at buying a loft space with an option to build like in the airspace above with the roof?
Big topic.
Does the existing structure have the capacity to hold those existing flats, or are you going to have to do a skeleton steel structure with beams spanning across the entire building? With steel span, and it's those considerations of when they're saying the deal, this is how much the deal is. Really make sure that you drill down on your due diligence when it comes to GDV, when it comes to feasibility to build.
And also the nuances in the deal, such as the law has changed a lot with timber frames and whether you can. You've got to put now air mist systems in all of your
that are above 9 meters, and 9 meters isn't high.
No, and all of these things come into play, and if you haven't calculated for all the new laws and all the new changes, and you've done your numbers just on the back of a postage stamp, then you could find yourself that you almost just break even, and that's not a good place to be.
I mean, you're not here. I mean, don't get me wrong, experience is great, but when you're at that level, you want to make some money.
Exactly.
Pause. Stop. Sorry, quick intermission. As we have no sponsors, you're the sponsor right now, so subscribe to this video if you're enjoying it. Also, if you haven't already, like, comment, all that good stuff. Now, back to the video. It's just, I think, really it depends on your own personal position and circumstance.
Yes, and your appetite to risk.
That is it. I think that is, although there's a lot of other factors, your appetite towards risk often comes down to how you decide to make your decision. So what's next for Lorraine Thomas? Are you buying? Next? What are we doing? What are we looking at?
I'm looking at two things. And I want to go down the commercial to resi route, only because I'm sick of planning, and I think this may be an easier route. And I'm also looking at a pub.
Okay.
And more to be revealed.
That sounds very interesting. So away from the Property by Kazy podcast, we also have, starting very soon, the Property by Kazy development tour. So we're going down 2 sites and seeing how people make money in property. So can we, if you secure this pub, we're going to come down to the pub?
Absolutely, 100%.
100%.
100%, yeah. Definitely.
That's good. So we are going to be excited to come and see one of your up and coming projects. Before we let you go, because both very busy property people, you see, aren't we? Super busy.
Time is money.
Time is money. Exactly. So before we let you go, if people want to find you, because you're doing some great things with the social property development programs, also with the sort of pooled funding and with the mentorship, how can people find you?
So my website is www.viewfrommywindow.co.uk. On Instagram, view underscore, all the underscores, but just type in view and I should come up. LinkedIn, Lorraine Thomas.
Amazing. And we'll make sure we get your links in the description below. Before we let you finally go, there's one question we ask all of our guests.
Go on,
and it's because people ask me the question all the time, and I'm great at, just basically just passing the buck. So I'm going to get you to answer the question. And it is, I'm 17, 18, I'm 19, I want to get into property, don't have loads of experience. what should you do? What's your answer to that question?
My answer would be, first of all, trust yourself that you can do it and get yourself a mentor. That's what I would say. Get yourself a mentor. Go with somebody who has done it before and can hold your hand through the process, and just somebody to bounce off, because property's a lonely place.
Okay.
That's what I would say.
So that's it. So trust yourself, again, personal self-belief,
yeah,
along with get yourself a good mentor to bounce ideas off. Lorraine also meant to say, just subscribe to the YouTube, which I'm sure you're going to do now to make sure you can catch every episode of the Property by Kazy podcast. We are going to be back next week with another amazing guest. I'll see you then.
Okay.
Yeah.
That's it. Great.